All right, welcome back to the comment section with Thomas Paul. Quick question. Did you wake up this morning thinking, wow, I'd really love to see my portfolio drop by 50%? Because apparently that's the new economic mood. And the best part? Some big shot billionaire or maybe even a certain ex-president just made a move that could drive the entire market into another epic nosedive. Sounds fun, right? Let's buckle up. Yes, you heard me. Wall Street, Main Street, and every street in between seems to have lost its mind. There's panic, fear, and maybe even some hair pulling, if folks have any hair left at this point. And here's where things get interesting. Even though it's scary, even though red numbers keep flashing like a bad disco fever, a lot of the smartest investors in the room are treating it like a 2-for-1 sale at the stock store. Why? Because discounted prices mean potential big profits. If you play it right. But is it really that simple? Let's talk about how the so-called pros take advantage of fear and how you can learn from it while ideally not losing your shirt. But wait, it gets even wilder. I know, you're probably thinking, isn't the market supposed to be calm when unemployment numbers barely nudge? You'd think so, but apparently going from 4% to 4.1% is the difference between a peaceful Sunday brunch and an asteroid heading for Earth. Now everybody's screaming, recession, stagflation, AI takeover. Actually, that last one might be me, but you get the idea. Add in some unpredictable trade tariffs, politicians on social media, and you've got a recipe for the spiciest stock market soup since 2008. Speaking of crazy leaps, let's talk about Palantir, because that stock soared about 20 times from its darkest days, only to see everyone freak out once it started dropping again. 1 minute, it's at $120, folks are dancing in the streets. Next minute, it's at 80, and people are lighting their hair on fire, yelling, sell! This roller coaster is not for the faint of heart. So the question becomes, do you run for the exits, or do you strap yourself in and hope for a second loop-de-loop? Now, for everyone who's new to the meltdown party, a little perspective. Markets go up, markets go down, and for some reason, we're always shocked. And trust me, I get it. Seeing a sea of red in your portfolio is about as fun as stepping on a Lego in the middle of the night. But if you think the best plan is to invest purely by feeling and panic, you're basically that person in a horror movie who hears a noise in the basement and decides to investigate wearing a blindfold. So, how do we keep calm when the 24-hour news cycle is screaming everything is doomed? First, we have to accept that the sweet, unstoppable bull run we enjoyed for a couple of years wasn't going to last forever. Unicorns and rainbow-sprinkled bull markets tend to fade eventually. This is a correction, or maybe even a deeper slump. It happens. The question is how to profit from it, or at least not get flattened by it. You won't believe what happens next. So many folks run to the buy the dip strategy like it's a quick fix. But as anyone who tried that in 2008 can tell you, that phrase is a double-edged sword. Sometimes you buy the dip, and it just keeps dipping and dipping and dipping until you're screaming for mercy. Then again, if you wait for the perfect bottom, you might miss the entire rebound. It's like trying to pick the best wave at a crowded beach. If you hesitate, you miss it. But if you jump too early, you get wiped out. Talk about an adrenaline rush. One of the big points is patience. Nobody likes hearing that. Everybody wants instant wealth like a hot pocket from the microwave. But remember, overnight success stories conveniently skip the years of unglamorous prep behind them. Building a solid portfolio is kind of like cooking a fancy meal, slow, methodical, and requiring some actual skill. Throw everything into the oven at max heat, and you'll burn your entire financial kitchen down. But let's inject some drama into the conversation, shall we? Because guess who's stirring the pot? Donald Trump with his talk of tariffs, a rumored crypto reserve that turned out to be built on seized criminal assets, and a social media meltdown that sent tech stocks plummeting. Yes, it's basically like a big reality show for the economy. The big reveal that the government won't be pouring fresh money into crypto? That was enough to make Bitcoin do a full belly flop. Everyone was expecting a heroic wave of capital injection from Uncle Sam, but in the end, we just got leftover confiscated coins from last year's black market bust. Surprise! If that wasn't enough, job data made the crowd even more jittery because apparently we can't handle unemployment rising a fraction of a percent. Now it's recession watch, flashing in neon lights. Fear? Absolutely. A rational reaction? Maybe, maybe not. That's the fun. Nobody's truly sure, and that's why the market is basically speed dating with volatility. But wait, it gets even wilder. Broadcom, yes, the big tech player that basically told us the AI investment wave is just getting started, delivers fantastic earnings. And guess what? Nobody cared, because the headlines were dominated by all the negativity. It's proof that good news can get lost in the firestorm of gloom and doom. Which means, ironically, you might see quality companies trading at cheaper prices not because they suck, but because everyone's too busy freaking out to notice their actual value. However, if you're sitting there saying yes, that means I should mortgage my house, buy everything on margin, and wait to be a zillionaire by Friday, let's just pump the brakes. Don't do that. I'm not your financial advisor, but come on, that's just a terrible idea. Timing the bottom of a major dip is like trying to catch a falcon in mid-flight. Unless you're super lucky, you're likely to get your face clawed off. So the question is, how do you navigate? And here's where things get interesting. You adopt a real strategy. You figure out how to spread your investments over time. You do your homework so you actually understand the companies you're investing in. If you bought Palantir or Tesla or any other high-flying stock at its peak just because stonks only go up, you've likely discovered the painful truth that stonks sometimes crash into the Earth's core. Reality can be brutal that way. Let's talk about building a sturdy foundation. If you have no clue what a company does, how do you expect to hold it when it tanks by 30, 40, or 60%? You'll be panic selling in no time. Imagine building a skyscraper without the right engineering. One little tremor, boom, Jenga tower. The same goes for investing. Otherwise, you're just a gambler in a fancy suit. But wait, it gets even wilder. The storm might just be starting. Or we could be at the bottom. Nobody really knows. And if somebody claims they do, well, they probably have a side gig reading fortunes at carnivals. What matters is how you plan for either scenario. Long-term strategies like dollar-cost averaging let you keep buying chunks of your favorite stocks or indexes as they go down. That way, if the market drags on for months or even 2 years, you can consistently build your position without lighting yourself on fire. Then, when the storm finally clears, you might look like the smartest person in the room. The main trick is not to run out of money halfway through a bear cycle, which is exactly what happens to folks who go all in at the first sign of red. Yes, it's easier said than done. It's about as fun as going to the gym. You know you should do it, but actually doing it every single time is a challenge. The emotional roller coaster can get to you, especially if you constantly check your trading app and see the floor dropping out from under your investments. But if you filter out the fear, if you get a handle on your own psychology, and if you're truly in it for the long run, you might find that fear can be your best friend, because fear drives prices into bargain discount territory. You won't believe what happens next. Some people end up making their biggest gains exactly during the worst periods. Yes, it's counterintuitive, but you buy when everyone's panic selling, and you sell when everyone's irrationally euphoric. Simple in theory, unbelievably hard in practice, because your best investment plan always looks downright insane in the heat of the moment. Everyone around you will be shouting, "Don't touch those stocks," or "The entire system is doomed." Meanwhile, the contrarians are busy shopping. Of course, let's not forget that some stocks might continue to be stinkers for a good reason. Not every discount is a diamond in the rough. Some are just lumps of coal that never turn into anything. That's why you need to do your research. There's a difference between a solid company that's temporarily battered by market conditions and a shady business model that's on a one-way trip to zero. So, no, simply buy everything that's red is not a sound strategy. But buy the right things that are red is how fortunes are often made. In that sense, the best question is, are you prepared to hold for, say, 5 or 10 years? Because if the timeline you had in mind is like next month, you're probably going to lose. Just like you can't plant a seed and expect a giant apple tree tomorrow morning. Nature's not that forgiving. But if you have the patience to ride the storms, and oh, there will be storms, your payoff might be huge. Speaking of payoff, let's circle back to some of these AI expansions. The big players like Oracle and OpenAI are shelling out billions to buy advanced chips. The AI wave is real, folks. It's not going away tomorrow. In fact, it's likely just beginning. Companies are investing in new technology at a frantic pace. That's a big deal. But in times of panic, nobody cares about future growth. They only care about tomorrow's meltdown. Which means, ironically, if you believe the hype around AI is more than just hype, you might be staring at a potential gold mine as the next meltdown creates bargains. That's the weird beauty of market crashes. They show us which businesses are built like houses of cards and which ones have real staying power. It's easy to look like a genius in a raging bull market, but come the tide going out, we see who's swimming without pants. Don't be the no pants person. That's awkward. If you're really serious about turning panic into profit, you'll want a game plan that extends beyond, I hope it goes up next week. Consider being systematic. Maybe you take the same amount of cash and invest it every couple of weeks or months, no matter the price. Then, if the stock drops to a certain threshold, you might allocate a bit more. That's called scaling in. It keeps you flexible and helps you avoid those lumps of heartbreak from going all in at the wrong time. Oh, but what about rebalancing? Some folks prefer to trim positions after big run-ups to lock in a portion of their gains so that if a crash happens, you're not left fully exposed. Some people get upset with that idea, but it might go up more, you trader. True, but it might also drop 50% next week and leave you crying in the shower. It's called risk management, and it's not as boring as it sounds once you realize how valuable it can be when the sea starts swirling around you. In short, the secret sauce is not a single magic bullet, but a combination of knowledge, discipline, and the ability to ignore panic-laced news blasts. And for the love of everything, try not to base your entire investment thesis on hot tips from your neighbor's cousin's friend who claims to be an oracle of finance. Now, don't go anywhere, because next we're diving into how mainstream media amplifies fear, how some big investors might manipulate sentiment for their own gain, and what you can do to protect yourself from all that noise. Trust me, you won't want to miss that. It's about to get spicy. All right, let's keep this train of chaos and sarcasm rolling. Before we go any further, I want to remind you that if you're enjoying this mildly deranged rant about markets, the economy, and how to avoid total financial destruction, drop a like, subscribe to the comment section with Thomas Paul, and let me know your thoughts down below. Are you still bullish, or have you started digging a bunker in your backyard filled with cans of beans? Let's hear it. So, mainstream media, helpful news source, or fear factory? Sometimes I wonder if they spend their mornings brainstorming how to make the mildest statistic into a catastrophic headline. Unemployment ticks up 0.1%. Is this the end of civilization? Clickbait sells. And it's not just a random phenomenon. Fear means eyeballs. Eyeballs mean ad revenue, and more ad revenue means you'll keep seeing those same headlines shoved in your face. If you're not careful, you'll start believing them. But if the daily news is telling you the sky is falling, you might dump your quality stocks at precisely the worst moment, maybe right before a bounce. It happens all the time. You won't believe what happens next. Some big institutional players have entire strategies based on how the media and the public respond to negative headlines. They make moves that earn them a quick buck when everyone else is running in terror. That's the system. We can rant about it, or we can learn to navigate it. And navigating it means we keep one eye on the data, one ear open to the narrative, and one hand on our wallet, so we don't blow it all at once. Now, for those of you who are heavily into AI or big tech, you might worry that a slump in the market or some fiasco with tariffs could ruin everything. But keep the bigger picture in mind. Yes, there are short-term hits to valuations, but the long-term technology trend might remain unstoppable. If you think artificial intelligence, cloud computing, or whatever your area of interest is, will transform the world, then you should probably want to buy those future juggernauts when they're cheap. Then again, not all tech darlings will survive. Think back to the dot-com bubble. Tons of them vanished faster than your paycheck on a Friday night. but the ones that made it, Amazon for instance, changed the world. So the question is, which are you betting on? You might be right, you might be wrong. That's investing. The only guarantee is that if you get in without a plan, you're likely to get burned. And here's where things get really interesting. How do you stay rational when your portfolio is bleeding red and headlines scream, "We're all doomed"? One trick is to stop checking your portfolio every 30 seconds. Seriously, you'd be shocked how freeing it is to invest in a disciplined way. Then, gasp, walk away for a bit. Give yourself space from the siren song of daily panic. Another idea is to build a network or join a community of investors with a similar time horizon who can help you keep perspective. Or find your favorite sarcastic YouTuber to talk you off the ledge. Just saying. Still, if your personal situation requires that your money be available in a year, do yourself a favor and consider whether you should be risking it in the wildest corners of the stock market. Because if you're investing cash you'll need for that trip to Disneyland next summer, you might end up with a goofy-level meltdown if the markets don't cooperate. But wait, it gets even wilder. Let's circle back to the point about how unstoppable rallies always seem unstoppable until they're not. Don't forget that Palantir soared from around $6 to over 120, a 20x rocket ride, then gave back a chunk of those gains in a blink. The lesson: there's no such thing as a guaranteed straight line up. If you made a boatload of cash on that run, you might consider taking some profit to diversify. And if you got in too late, well, lesson learned. Next time, understand the business fundamentals instead of chasing hype. That leads us to the burning question. How do you spot a panic discount versus a falling knife? In a meltdown, everything can drop, but not everything is equally vulnerable. The job is to figure out which companies have real revenue, strong balance sheets, good management, and a path for growth that remains intact even if the economy sucks for a year or two. That's the challenge. It requires you to do more than scroll Twitter looking for hot tips. But if you put in that work, you might find some serious gems. Let's also not ignore the geopolitical drama. Trade wars, tariff threats, supply chain issues, these can create short-term chaos, but they also open windows. It's like if your local grocery store had a panic about bananas and they marked them all 50% off. If you know how to make banana bread, which is basically the only thing I can bake, you might see that discount and think, time to stock up. But if you hate bananas, that discount is useless to you. Same goes for companies. If a short-term panic doesn't affect the business's real future prospects, you're basically picking up prime fruit for cheap. At the end of the day, the markets reward those with conviction, patience, and a sense of humor. Because, let's face it, you'll need one in these times. Embrace the chaos, but do it smartly. Consider dividing your investable cash into multiple tranches so you can buy at various intervals instead of going all in like it's Vegas. Keep some dry powder on the side in case the market hands you an even better discount. If you're using margin or leverage, be extremely cautious because the market can stay irrational longer than your margin account can stay solvent. And speaking of staying solvent, not everyone can hold through those bone-crunching drops without blinking. That's why you might sometimes trim positions if the euphoria is out of control. Not because you've stopped believing, but because your risk tolerance is telling you to lock in a bit of profit. If that stock then proceeds to go higher, oh well, you still made money. If it goes lower, you're protected. That's a strategy, not betrayal. All of this circles back to the reason we're here. To navigate a world where Donald Trump can tweet something that knocks the entire crypto market off a cliff. Where a big rumor about AI chips can send a stock skyrocketing or crashing. And where the mainstream media's job is to keep us perpetually teetering on the edge of panic. It's a circus, folks. But we have to learn to dance in the ring if we want the big prizes. So, what's next for the market? Are we heading for a meltdown to end all meltdowns, or will everything bounce back next week, leaving short sellers wailing in despair? Honestly, no one knows. The best you can do is position yourself in quality, maintain a balanced approach, and keep your timeline realistic. And hey, if the worst comes to pass, at least you can watch it all here with me, and we'll turn it into some sort of comedic therapy session. Which brings me to the final, yet most important part of this show. What do you think? Are you bracing for more volatility? Or is this the perfect time to throw caution to the wind and go on a buying spree? Let me know in the comments. Seriously, your hot takes, your gloom and doom predictions, your we're all going to be millionaires fantasies, I want to hear it all. And if you got value from this video, or at least a few laughs, make sure you absolutely smash that like button, subscribe to the comment section with Thomas Paul, and share this video with someone who could use a friendly reality check or a good laugh right now. Invest safe, keep your sarcasm levels high, and I'll catch you in the next video. Until then, remember, every meltdown is just one more chance to thrive, provided you don't run out of money or, hope.